Imagine a time when market uncertainty has many investors frozen. Three exceptional stocks are now trading at their lowest valuations in years, yet they still offer robust growth potential and dependable dividends. These are not speculative plays. They are well-established industry leaders, backed by strong financials, consistent cash flow, and enduring consumer trust. Right now, they're significantly undervalued, presenting a rare opportunity just as the broader market hesitates. Experienced investors recognize this as a rare, high-conviction moment to build long-term wealth. While Trump's aggressive push for renewed tariffs is shaking up global markets, and while most investors are running for cover, smart money is quietly preparing for one of modern history's most significant wealth transfers. These aren't just headlines, these are signals. Certain industries get crushed every time tariffs increase, but others explode with opportunity. In this video, I will explain exactly how this shift is happening, which sectors are about to pop, and the specific stocks that could turn today's fear into tomorrow's fortune. If you're tired of sitting on the sidelines while the market moves without you, now's your chance to make bold and informed decisions. Let's get 500 likes on this video. With you, it's possible. Subscribe to the channel if you're new, tap the bell notification so you don't miss out on new content like this. Note, I'm not a financial advisor, and this is not financial advice. So, always do your due diligence. And I would appreciate it if you could try answering the question at the end of this video. So, let's get straight into it. Let's start by defining the criteria I use to select these stocks. I focused on three things. 1. Undervaluation. Each stock has a forward price-to-earnings (PE) ratio at least 50% lower than the S&P 500 average. That means you're paying far less for every dollar of earnings. 2. Dividend strength. All three stocks offer dividend yields over 2%, with consistent payout histories. In some cases, you're earning 5 to 6% just for holding the stock. 3. Oversold territory. Every one of these companies is trading near or below its 52-week low, with RSI indicators below 40. That suggests heavy selling pressure and possibly a bottom forming. So, with these filters, what came up? Let's break it down. The first stock offering rare generational wealth is Chevron, ticker symbol CVX. Chevron is a name every investor recognizes but few truly appreciate in the current market. Over the past 2 years, the stock has traded mostly sideways, leading some to label it dead money. But that's a surface-level take. Underneath the slow share price is a company with one of the strongest financial foundations in the energy sector. Chevron maintains a fortress balance sheet, low debt levels, and consistently strong free cash flow even during periods of low oil prices. This allows the company to continue rewarding shareholders, regardless of short-term volatility. At today's levels, Chevron offers a dividend yield close to 5%, translating to $6.84 per share annually. That's among the highest yields in the sector, and unlike some high-yield stocks, this payout is well supported by earnings and cash flow. In fact, Chevron has increased its dividend for more than 35 consecutive years, earning it a place on the Dividend Aristocrats list. That means you're not just buying income today, you're buying a growing income stream for the future. What's weighing on the stock right now is the pending merger with Hess Corporation. The deal, originally announced in late 2023, has been delayed due to regulatory scrutiny and arbitration involving ExxonMobil's stake in Guyana. But once the dust settles, Chevron stands to gain access to one of the most promising oil discoveries in the Western Hemisphere. Combine that with a potential rebound in oil prices and rising global demand, and CVX could quickly shake off its stuck label. Analyst price targets currently sit between $165 and $168, implying an 18% upside from current levels. Add the nearly 5% dividend, and you're looking at a potential total return of over 20%, not bad for a company many have written off as boring. This isn't a meme stock or a moonshot. It's a slow and steady compounder that quietly builds wealth in the background. Chevron is the kind of stock you tuck into your portfolio, collect income from every quarter, and let time do the rest. It's not flashy, but it's rock solid. Do you see this dividend stock as something to watch out for? Now let's move on to the second stock set to make millionaires in 2025. UPS is a logistics giant at a discount. United Parcel Service is facing some tough headlines, and that's precisely why value investors should start paying attention. The company is dealing with multiple challenges: weak consumer demand, higher labor costs following a major union agreement, and the looming possibility of losing Amazon as a major client. Add it all up, and the stock has dropped over 30% year-to-date, hitting levels not seen in 5 years. But if you zoom out, this kind of pricing dislocation rarely lasts when dealing with a company as fundamentally strong as UPS. UPS is trading below $100 per share, with a sky-high dividend yield of over 6.7%. That's $6.56 in annual payouts, real, tangible income you can count on while waiting for a turnaround. And unlike many high-yield plays, this dividend is supported by decades of consistent earnings and operational discipline. UPS didn't get to be a logistics powerhouse by accident. The company runs one of the most sophisticated delivery networks in the world, with operations in over 220 countries and territories. Its infrastructure is nearly impossible to replicate, and it continues to play a critical role in the global supply chain. What's more, the long-term growth story is still intact. E-commerce demand is expected to keep rising over the next decade, and while Amazon may shift more deliveries in-house, other retailers, especially small and mid-sized businesses, are leaning more heavily on UPS to handle last-mile logistics. UPS has also been investing in automation and AI to improve efficiency, cut costs, and future-proof its delivery network. Analysts currently forecast a 30% upside from current levels, with some setting targets north of $125. That potential for capital appreciation, paired with a generous and stable dividend, creates a rare risk-reward setup. This isn't a speculative rebound play, it's a temporarily undervalued blue chip with serious staying power. UPS has weathered recessions, market crashes, and countless macro shocks over its long history, and each time, it emerged stronger. UPS deserves a spot on your watch list if you're looking for a stock that combines income, value, and resilience. Last on the list is one you might not expect: Campbell Soup Company. Yes, the brand you probably associate with canned soup and nostalgic commercials, but there's more here than meets the eye. Campbell is a classic consumer staple with an underrated edge. This company has been around for over 150 years, and its products, soups, snacks, and sauces are found in virtually every American pantry. That kind of brand penetration matters, especially during economic slowdowns when consumers trade from restaurants to affordable meals at home. Right now, Campbell is trading at its lowest level in 5 years, hovering under $36 per share. That's even though its core business remains stable. Campbell has consistently generated strong free cash flow, maintained a healthy payout ratio, and avoided excessive debt, all signs of a well-managed company. You're also getting a dividend yield of around 4.3%, higher than the average for most consumer staples and better than many treasury bonds. That means while you're waiting for the stock to rebound, you're collecting real income. What's weighing on the stock? Inflationary pressure, rising input costs, and fears around shifting consumer preferences. But here's the thing: Campbell is already adapting. The company has expanded into higher-margin snack products through acquisitions like Snyder's Lance and is leaning into innovation to modernize its product lineup. And with its low beta, CPB tends to hold up better than most stocks when the broader market dips. That defensive quality becomes incredibly valuable when volatility spikes. Analysts are projecting a 23% upside from current levels, which may seem modest, but remember, this isn't a growth stock. It's a stability play. Campbell isn't trying to double in a year. It's designed to preserve your capital quietly, balance your portfolio, and generate consistent returns regardless of economic conditions. If you're building a long-term portfolio with a mix of growth and protection, the 3 stocks deserve a closer look. In a world chasing hype and headlines, sometimes the best moves are the quiet, defensive ones that keep delivering year after year. But for now, please do your due diligence. Remember that I'm not a financial advisor, but if you enjoyed this analysis, please like and subscribe. I hope you'll be able to use this information to the best of your knowledge. See you in the next video.